This is a topic that has come up in the past, tends to come up at just kind of stressful times when market or the economy is not doing well. And I think that this question comes up a lot because, few of these large custodians hold just a ton of assets. And most retirees tend to consolidate accounts over time. And this leads to most, if not all, of their assets ending up seemingly under a single roof. And I also think that this concern is just on many people's minds because we are more used to hearing about banks going under or, a run on a bank and depositors' money being at risk. And we just assume that something similar can happen to any other type of financial institution like these brokerages. And, just to start to kind of make one quick point here, thankfully, that is not the case. Brokers like Vanguard and Schwab and Fidelity operate very differently from a bank. Most of this is because there were a lot of protections that got put in place after the Great Depression, and even more rules were passed in the early 1970s after a wave of brokerage failures kind of in the late 60s and early 70s. And so the SEC requires that brokers keep customer assets in separate accounts from, the general company funds. So these are, yep, completely separate. They can't tap into these to help pay their bills. And then in addition, even if the brokerages run into some kind of financial trouble and have to go into any bankruptcy, laws are there protecting client assets from any creditors in bankruptcy. It's not even possible for them to, use your brokerage account to settle their debts with Vanguard or any of these other companies. And in addition to that, the SEC has several other rules that require these brokerages to report liquidity at least weekly. 11 of the largest firms report this daily. And so this is monitored. If these companies start to get into financial trouble, they're going to get a visit from these agencies to make sure that they're operating in a responsible manner. And there's general minimum liquidity requirements for all these companies as well. And so just to try to show an example of how different these businesses are ran, I'm comparing here just a small regional bank. In this case, it's Midwest One Bank, kind of a local bank to us here in Iowa. Again, relatively small, but a very kind of just pure bank. They don't have a lot of other business activities going on. They hold $5.3 billion in deposits. And if you look at the company's balance sheet, you see that very clearly under the liabilities portion of their balance sheet. And so you can see here, if you have your money in Midwest One Bank, it is a liability on the company's balance sheet. They owe you this money technically, right? Compare that to something like Robinhood. So this is one of the smaller brokerages out there. I'm showing them again just because their balance sheet's a little cleaner than some of these larger brokerages out there. So Robinhood holds about $119 billion in customer assets. But notice on the liabilities portion of their balance sheet, there is nothing close to $119 billion in liabilities. Your money that's in Robinhood just is not even considered Robinhood's money. It's not listed on the balance sheet. It's completely separate. And this, I thought, was just a good way to kind of very clearly show how these companies are different. When your money's in a bank, it is technically the bank's money. They're doing things with that. They owe you that money. Robinhood or any other brokerage, very different. It's not considered theirs at all. We have some precedents actually of what happens when a large brokerage firm goes under. And so, for example, Lehman Brothers in September of 2008, they had just under $200 billion of customer assets, so a little bit bigger than Robinhood is today, when they failed. And so September 19th, 2008, you saw in the news headlines that Lehman's brokerage firm had failed. So that's probably a very scary thing to see when you have all your money there in their brokerage. by September 23rd, just under 90% of the accounts were transferred to other brokers. Very quickly, companies, Barclays was the big one, purchased Lehman's brokerage division and moved accounts over just, again, 4 days later here. And so certainly, some kind of delay here. You might have had a few days of your account being transferred to Barclays, but no brokerage clients lost any money, and relatively quick process to get that money over. There were a few accounts that took longer to transfer over, but it is not just retail accounts. These had more complicated dealings going on. Things like hedge funds who had loans with Lehman to finance some of their investments. Those took some time to resolve. Everyone was made whole, but very general, kind of retail investors very quickly moved over to different brokerages with very little interruption and no losses at all. And then there's a question too, usually about mutual funds and ETFs. So not only, your money that's sitting in Vanguard or Schwab, but you might also have a very large portion of your money in funds managed by a single company. So maybe all your money is in Vanguard mutual funds, for example. I put a list here of just some of the largest mutual funds so you can see that there are tremendous amounts of money in some of these funds. And thankfully, there's very similar protections for these funds as well. Since 1940, mutual funds and more recently ETFs are required to keep their assets separate again in a qualified custodian account. And so, for example, Vanguard's largest fund, their total stock market fund, has again over $1 trillion in assets. Those assets are not even kept at Vanguard. They're kept by a custodian with JP Morgan Chase Bank, just for this example. And that is a safeguard for investors. If Vanguard goes bankrupt, that money is not even in Vanguard for Vanguard to tap and try to pay their bills with. JP Morgan's responsible for keeping track of that, keeping that safe, ensuring that any withdrawals are not against the fund's normal operating procedures. In addition to that, these funds are each their own kind of separate entity. In this case, they're trusts. And so even if Vanguard brokerage firm is sued for some kind of wrongdoing, this money is in a separate trust outside of Vanguard's legal business. And then kind of the third level of protection here is that all of these have independent auditors. And so in this case, Vanguard uses PricewaterhouseCoopers to be their just kind of public accounting firm. They're auditing these statements from Vanguard, from JP Morgan Chase. And then, of course, the SEC is monitoring all this too. And so there's lots of different levels of protection here that prevent money from being used for non-fund purposes. And once again, Lehman Brothers was a really good example of what can happen. Lehman Brothers operated several mutual funds in 2008. Their largest fund, which was called the Genesis Fund, was a small cap or a small investment company that had about $12 billion in assets at the time that Lehman was failing. And I just like noting that $12 billion amount because Lehman was trying to sell itself for somewhere around $5 or $6 billion before it failed. And so if Lehman could have gotten a hold of $12 billion in assets, they would have. It would have saved the company. And so, just a good example that this money was separate, not able to be tapped, even though they maybe really would have liked to get their hands on that money. And then in addition, that fund is shown in the purple line in this chart here. You can see the performance of it did go down during this time, but it did not go down much more than just a general small cap fund. So the orange line here is just Vanguard's small cap mutual fund. And so you can see, if there was significant concern from investors that this mutual fund was going to be worthless, you would have seen price drop much more than it did. So just tend to follow the performance of general small cap stocks at that time. And the fund continued on. It got purchased by another company, you can see here, continues on to this day. And so again, no real big interruption for investors in Lehman's mutual funds. One note here that the kind of protections that I talked about in these last couple slides exist for many just kind of standard investments, most stock mutual funds, bond mutual funds, ETFs. There are a few places this doesn't apply, just to be clear. So if you are buying securities on margin, that can result in some of these protections not being there. You're taking a loan out from your brokerage, and I think that brokerage gets a claim on those assets first. It's not as segregated. Likewise, if you lend out your securities, some brokerages give you the ability to let your shares be lent out for short sellers that can give you a little bit of income. That removes some of this protection because now you're lending these securities to someone else and not just keeping everything under Vanguard's roof, for example. Cryptocurrencies are a big thing just to be aware of. These protections do not exist for that. And then there's something called ETNs, or exchange traded notes. These are not ETFs, exchange traded funds that we use that are much more common. Exchange traded notes are funds that are derivative based. And so this is a lot of like commodity funds. A fund might not want to own $1 billion worth of physical timber, so they'll just use derivative contracts to have exposure to the price of timber, but they don't actually own that physical commodity. And so that's something that is at risk in this case. And for example, Lehman Brothers had a few ETNs where investors did lose money. They lost a little bit more than half of their money in those funds when Lehman went bankrupt. Few other types of investments here also, limited partnerships are one. And just to be clear, these are not investments that our clients own in their Schwab accounts or that we purchase for them at the very least. These are more complicated types of investments. These are not your just general stock and bond mutual funds and ETFs that you are familiar with. And then lastly here, you've seen on your statements and likely heard just, maybe in the news as any, kind of recession comes, as the economy doesn't do so well, that you have SIPC insurance on your accounts. And so what is that? Just at a general level, that protects up to $500,000 in assets with a limit of just $250,000 in protection for cash. That protection is there as in what's called a separate capacity, which generally just means per account type. And so, for example, a married couple at Charles Schwab, for example, if they have a joint brokerage account, that account has up to $500,000 in protection. The husband and wife might each have their own IRAs and Roth IRAs. Each of those accounts have $500,000 in protection. And so just in this example, between these 5 accounts, that's up to $2.5 million in protection for this couple. And again, with a max of $500,000 in each account. And so people see those numbers, and again, just because I think we're familiar with the FDIC, they kind of think that these coverages are very similar. But what SPIC is really covering is things like fraud, where your investments just go missing. SIPC does not protect against, the loss of any investment value. If you buy Microsoft stock and Microsoft goes to zero, SIPC is not covering that. They're not covering several other types of investments. Really what this is for is if when, for example, Lehman Brothers fails, SIPC comes in and looks at the assets that are on your account statement and making sure that they're in that custodial account. And if they are not, that's when SIPC pays out. And so again, this SIPC is really there for examples like Bernie Madoff, right, who was his own custodian, was his own security clearing firm. When you invested with Bernie Madoff, you wrote Bernie Madoff a check, right? You did not write Charles Schwab a check or Vanguard a check. And so what happened, just for those curious, with Bernie Madoff, Those accounts that had $1.7 million or under have been repaid. Larger accounts, they're still actually collecting money and paying investors back on that. But that's a scenario where SIPC actually had to jump in. There's been lots of other smaller cases, so kind of very rogue, very small brokerages that have failed. But this is not something that's there for that you'll see, with Schwab and things like that. SIPC is very rarely used. Just to put some numbers out there that I thought was interesting to kind of compare FDIC versus SIPC. FDIC, so since 1970, when SIPC was created, there's been about 3,600 bank failures. In the last 24 years alone, 562 of those bank failures have resulted in depositors actually losing money. So this is people that had money over FDIC claims. There weren't enough assets at the bank to actually pay people out. Compare that to the SIPC, which over the last 54 years has seen 1/10 of the number of brokerages fail as banks, just 330 over the last 54 years. And in total, there's been 355 individuals. I think this might actually be 355 households, really, that have lost any assets at all. So 355 people over the last 54 years. And there's a interview with the head of the SIPC that he clarifies this, saying most of these 355 are from prior to 1978, when there was a much lower limit on SIPC coverage. And so just thought this was a good comparison to have. SIPC is much less, used or even applicable for what you kind of fear, happening in your accounts. There's very, very good procedures and structures in place for companies like Schwab and Vanguard, where money's segregated, not able to be accessed for general company purposes. And really where SIPC is even applicable at all is for very small companies. So if someone's coming door to door to you wanting to get you to invest in their mutual fund, you might want to make sure SIPC is there. For your investments in Schwab and Vanguard and Fidelity, it's not really something that's quite honestly that applicable because the SEC and FINRA have other rules to keep your money safe there. And one last thing I was just gonna go through on your investment statements. You'll very often see something like a bank sweep. And so I've shown here just an example of how this looks on Charles Schwab statements. You'll see that the cash in your account gets swept to a bank. And what this is doing, this is Charles Schwab actually moving money from your brokerage account into FDIC insured banks. And so in your brokerage accounts, you can typically have more than $250,000. And Charles Schwab, in this case, or your broker, will move that to different member banks to ensure you have more than $250,000 in FDIC coverage. And so this is another feature also that, again, just keeps your assets in brokerage accounts very safe, where you're getting that FDIC insurance and you're likely getting more than $250,000, even though you might have more than $250,000 in cash in your bank. Just wanted to point that out because that's been a question before as people review their Schwab statements, wondering what these bank sweeps are. And that's just Schwab or other brokerages can do this too, giving you extra protection for your assets.
We will hang on here, and we do have one question through the chat that we'll get to in a second, but if there are any other questions, feel free to post those or hang on. So the question we got through the chat is a good one, specific to things like a hacker or a cybersecurity attack. What kind of protections exist at the brokerages for those types of threats? So this would be sort of an outside party, not somebody that was working at the company and they get into your account and steal securities or cash or something like that, or some other sort of attack related to that. I think generally, Matt, you might know differently, but generally the brokerages each have their own individual guarantees on this. I can tell you that Schwab has a security guarantee. You can find it by probably just Googling the Schwab security guarantee on the web, where they outline what steps they're taking to protect you digitally, and then and kind of what's their responsibility for this. So what Schwab does guarantee is that they will reimburse you or restore your assets for anything that is not caused by your own issue. So that they're going to place some responsibility on you if for some reason they would find out that you've shared your login ID or password, transaction information, something like that, with the hacker. Then they do not have protections in place for that. But if they are hacked and something happens to your account, they will reimburse you for any damages related to that. I just quick look too. It looks like Vanguard also has a similar guarantee, and you can find that on their site as well. How they reimburse for cyber threats like that. Looks like it's essentially the same guarantee where they will restore your account. So good question on that. Matt, anything to add on the kind of cyber threat?
No, I think that's good.
All right, we'll wrap it up there. If there's any further things or future topics that you'd like to discuss, please reach out. And we'll look forward to seeing you on next month's webinar.